right here, you can see the thing that's called a short squeeze, which happens when people who trade on margin buy a bunch of some asset, and then suddenly someone sells a bunch of that asset, and suddenly people who bought on margin lose all their money. And this is something we will talk about, how you can actually profit from it and how you can predict things like this or something a little bit less crazy than this. So what is margin trading in essence? It's basically borrowing money to buy more of some asset, or it can also be borrowing some asset to sell it, even though you don't actually own it. So that's long positions and short positions. This is actually a question that comes up a lot in our chat room. So long doesn't mean long term like some people think. It means buying something. And usually is used in context of margin trading. So you borrow money from either the exchange or some other people to buy something. So for example, if you're expecting like you're here and you think Ripple will go up because it's amazing, so you can go long on margin, buy more than you can actually afford, and then it goes up, you're making profits, and it's great. That's how it works. So for example, if you bought Bitcoin in, let's say, 2013 or 2014 for like $100, you bought one Bitcoin, great, you made almost $10,000 now. If you were actually trading on margin, you could have bought, let's say, 5 Bitcoins with just $100 because you use the borrowed money, which is called leverage. If you're using 5 times leverage, 5x leverage, that means you can buy 5 times more asset with the same amount of money. So from that one Bitcoin, you would now have $50,000 instead of $10,000. That's the gist of it. Obviously, it's not always that safe because prices never just go straight up, but that's the idea. So why margin trading can lead to things like this funny candle is because if you're buying something on margin, let's say you bought one Bitcoin now today for $9,000, and you only have $9,000, then obviously you don't need to use margin. But let's say you want to buy 2 Bitcoins with $9,000, so you're borrowing $9,000, and you still only have that amount of money, $9,000. If the price goes down to a certain point, the exchange has to make sure you can actually repay that loan. So if you bought one coin on margin and then one with your own money, if the price goes down 50%, exchange will sell your coins because that's your limit, your loss. To make that example a bit easier, let's say you have $1,000 and you're using 10x leverage, which means you're using 10 times multiplier. So if the price moves 10% down, that's your limit. If you have $1,000, the price moved 100, it's multiplied by 10. So that's $1,000 already. You have to pay it back to the exchange. You get liquidated. What happens is exchange will sell your asset to cover that loss. So what happens when this kind of thing happens is that a lot of people have a lot of asset bought on margin, borrowed money. So someone starts selling, the price goes down. Then people actually have to sell their assets to pay back that borrowed money. And it kind of leads to this cascade of sells when every sell makes the price go lower and then lower and lower. So people have to keep selling because the exchange forces them to do so because they borrowed money to buy it. This example is great because the price went down like half almost. If you had a buy order set somewhere here, you're rich now, kind of. But there are better examples of it, of why margin trading can be dangerous, and we will go into how to avoid it. If you look at Ethereum, I'm not sure how many people were around back then in June last year, but if you look at Ethereum on GDAX, that happened in June last year. Yeah, so if you look at this chart, the price literally went to 0. So what happened was people basically sold a bunch of Ethereum, which was more than exchange had on the order books total for buyers. Basically, no one had buy orders placed below a certain price point. So people trading on margin, because at that point GDAX actually had margin enabled, it doesn't anymore, but at that point people had a bunch of Ethereum bought on margin with borrowed money. And then when their orders have to close, because suddenly the price is lower than their liquidation point, it just keeps going down to 0 because there's no buy orders. It just tries to sell, that exchange engine just tries to sell their coins, but there is no buyers, so it just tries to sell lower, lower, lower. And eventually there was actually some funny stories about people who had like a random 10,000 Ethereum buy order at like 5 cents per coin, and they actually got executed. People actually bought like thousands of Ethereum for a couple $100. If you search Reddit, you can actually find those stories. People actually made that money. There's videos of it. It's pretty funny, but also pretty sad for people who lose money that way. luckily for anyone who traded on GDAX actually funded those trades. So that's not too bad for them. But there are similar things with other coins, and actually we had some people in our chat room who trade on margin who got liquidated by similar movements, like not to zero, but like 50%, 60% down. So the thing with margin trading, and what really should be the first thing to learn about it, is you should never ever use your entire balance, your entire trading balance to trade on margin. That's like #1 rule. You should always treat anything you put into margin trading as money that can just disappear if you're unlucky. There are always ways to mitigate risk. You can use stop losses, you can like be more conservative with your trading, but always you have to keep that in the back of your head that if someone decides to just like destroy the price and floor it, this is what can happen. It can go literally to zero, and it's not something you can be sure you can avoid. No matter how safe you trade, no matter what you do, there is always like 0.01% risk that your entire account can be liquidated, regardless if you're in a short position or if you're in a long position. If you're selling or buying, things can happen. So for anyone thinking about trading margin, that's the thing you should have in your mind always. You can trade with 1% of your trading stack, 5%, 10%, whatever your risk tolerance, but never your entire crypto holding, because you can be successful for a year, you can have like a great profitable year, and then just one thing happens and you are wiped out completely. There's actually, again, a lot of stories like that, people posting on Reddit, like, I had 1 Bitcoin, I was margin trading, I made 300 Bitcoins, and then it became 200 Bitcoins, it became 100 Bitcoins, it became 10 Bitcoins, and now I have 0, because I'm a greedy idiot, basically. So that's #1 rule, you never trade with the entire account. And generally, it depends on what exchange you use, your limits on leverage and margin trading, But if you're using the most common margin trading platform, BitMEX, it offers this great opportunity to use 100x leverage, which means all the profits you make are basically multiplied 100 times, right? So if you have 1 Bitcoin and you use 100x leverage, it means every price movement is multiplied 100 times. So let's say you have 1,000 in Bitcoins, that price goes up $10, suddenly you made $1,000 from a $10 move. That's great, but it works against you as well. So if you want to trade with high leverage, you should never enter large positions right away. Like some people talk about, I just bought Bitcoin, I went 50x, I made $1,000 or whatever. That's just stories of people who got lucky. In reality, if you want to trade on high leverage, it takes time. You take like a week or a month to build a good position slowly. So don't think about leverage as some kind of a tool that just makes you money quickly. It's something that takes a lot of patience and it takes a lot of risk management. So if you want to trade on margin, you definitely have to learn how to take losses all the time. Anyway, that's I'm getting a bit carried away. So we'll go back to the more important thing first. So margin positions and how you can learn. How you can learn how to use them just as a market indicator. That was the first thing I really wanted to talk about. And let's get back to that. So Bitfinex is the biggest Bitcoin exchange still. I guess Binance is actually bigger now. No, Bitfinex still has more volume. So Bitfinex is the platform where really the biggest Bitcoin trades happen, and also the platform which has margin trading. So we can use this trading view. What was it? One second.
Internet is slow here.
No, I just need to find the right link. One sec. Google to the rescue. Where is it? Is it this one, I think? Right, so at any time we can actually see the amount of margin positions opened on Bitfinex, which is really the leading market for Bitcoin. So you can kind of like assume the general sentiment on Bitcoin based on these charts. So right now you can see there are 29,000 margin long positions open, which means people bought Bitcoin with borrowed money, this amount, 29,000, which is not particularly high. Not low, but not that high as well. And if you look at shorts, that's the amount of coins people sold on margin. So if you can basically think of shorts as people selling. Anyway, it's the same thing as selling, and long as people buying. So how you can use this as an indicator? If you look back a few days, well, it's more like a couple of weeks now. Let me get rid of this thing. Right. If you guys remember when Bitcoin price was about 6.5 thousand for a few weeks, it was stuck there, and a lot of people were talking about how the prices might go lower. We might see Bitcoin at like 3,000 or something. If you followed any kind of like trading communities, a lot of people were calling for that. And actually, I really disagreed with that. And if any of you are in that Crypto Korea chat group, you would probably seen that when we were at about 6.5 thousand, I was saying we will probably see a reversal at some point soon. This was one of the main indicators I used to determine that. This short position, it was actually the amount of shorts, which is people borrowing Bitcoin to sell it, hoping to buy it cheaper, was growing basically every day. It was going up and up, but the price was staying somewhat stable. If you look at the price chart, let me find the Bitcoin price chart for the same dates, so you can kind of look at it side by side. Let's say 1 day, and April 11 is right. So this was the price of Bitcoin. It went down a little bit, and then between March 30 and April 11, it was more or less just moving in this range, like almost $1,000, but never really breaking down too much, never going up too much. So what was happening to the short positions is it went down a little bit, then it went up, and it went up more, which means people are expecting the price will go down, so they're trying to get those short positions, sell that Bitcoin. But then the price doesn't actually react to people selling, which means there are enough buyers at this price level that the price just doesn't go down anymore, right? So when you see this kind of thing, you can't know for sure, tomorrow the price will go somewhere, but you can get an idea for kind of like a more stronger overall trend is that, this is probably the floor or close enough to the floor. Because if people sell, what was it, like 40,000 Bitcoins that they don't even own, they're borrowing someone else's Bitcoin to sell it, that means there are really not many sellers left. Because usually if you have, let's say, you have 10 Bitcoins of your own and you think the price will go down, what do? You sell your own Bitcoins first, the price goes down a little bit more, you think it might go down further, then you borrow someone's Bitcoin on margin to sell more and make a profit from this downwards move. So at this point, if there is so many shorts open, it means really like so many sellers are committed, there is not many people to sell. And then what happened is, you guys remember, right? We went from 7,000 to 8,000 in literally like 1 hour. And that's this chart dropping off, that's the shorts closing, because people who borrowed this Bitcoin, they actually have to buy it back to repay that loan. So that's kind of like, it's called a short squeeze, and that's what happens when one side of a position is overloaded too much. The same thing happens with long positions. If you look at Bitcoin USD longs, I'll find a good example in a second, hopefully. So, for example, a few days ago, when the price was going to almost 10,000, this spike here to 9.8 thousand. Again, you could get a sense that it will not move much higher based on that margin position indicator. Here, if you look at April 25, the price goes up to like almost 9.8 thousand. If you look here, overall on the entire scale, yeah, there were times where there were more margin positions open, but for this local period, suddenly we had a lot of people borrowing money to buy more Bitcoin. So at this point, you can kind of realize that this move is not going to be sustainable much more, because the price already moved so much. That in itself is an indicator, right? People know how crypto doesn't just go straight up. But then if you combine it with the margin positions, you can really get an idea that here is probably like somewhere, really like last few percent of this move up is somewhere here, when this margin position indicator moves so sharply with the price. So how you can use it to your advantage is basically always have an idea of what's the average level for the current price. Like for example, right now, 29,000 is the average. Since pretty much like what, 2-3 weeks ago, this is the level we are at always. 28, 29, 30,000 Bitcoin long positions. That's probably just long-term positions that people entered way back and they're not touching them, they're not moving up or down. But then if tomorrow, for example, we saw again this kind of spike of long positions going up, then you could think, this, whatever the price is at now, this is probably going to be close to the limit. It's not going to move much more because, again, people committed their money. That's where the move will end. It never happens like, people open positions up to 35,000 and like 40,000, 50,000. It doesn't happen because there is a limited amount of money available in the market at all times. So you can see levels like here, a little bit further back. Yes, here for a while we had a much higher level than the spike even. But again, it was kind of like a sustained level. So the normal for this time period was much higher than here. So you always look at the time period, like a specific time period, what's the normal for this time period rather than a specific number. There is always that number is changing. Like here again, you can see there's always like a flat period, kind of flat periods and a spike. It goes back down and finds a new flat period. And that's something you can't really, you can't really put a specific number for something like this. You can't say, whenever margin long positions goes to 32,000, that's when you sell. Whenever margin goes to 40,000, that's when you sell. There is no number like that. But instead you can just look, the positions changed by, let's say, 20% in one day, then you can probably expect that this is going to be the end for this current move. The same goes for long position and short positions. And the second indicator you can use with this is the funding rate, which means basically how expensive it is to maintain a position or how cheap it is. Because when you're borrowing money, obviously you have to pay someone for that, right? If you borrow money from a bank, you have to pay interest. If you borrow money from an exchange to trade, again, you have to pay interest. But the interest for margin trading is extremely variable. It's very volatile. It changes from like 0.01% daily to almost 1% daily. And actually, at sometimes there was even interest rates of like 2%, 3% daily, which obviously is crazy for like bank, but for crypto, crazy is normal. So how you can see that funding rate is either you have to sign up for an account with Bitfinex, or you can use this little site called datamish.com. And I actually definitely recommend everyone save this website, datamish.com. It is extremely convenient for anyone interested in looking at margin positions or margin funding rates, and really can be a very convenient gauge of like market sentiment. So you can see both the number of margin positions, short and long, opened here. You can see the price basically kind of like overlaid with margin positions. It's not actually an overlay, but you can see how the price moves in sync with this graph. So here we see the margin long positions are low, they start opening, that pushes the price higher. That's the effect of margin trading, really. And then you can see the funding rate here somewhere as well. Where is it? Funding rate. Oh, here, lending rate. Yeah, so that's the lending rate for US dollars and Bitcoin. So if you're short, then you're paying the rates in Bitcoin, obviously. If you're long, you're borrowing dollars, you're paying rate in dollars. So actually, if you look at these rates now, it's actually kind of not that good of a picture for anyone bullish, because the funding rates are much more expensive in dollars than they're in Bitcoin, which means there isn't that many dollars available, and you have to pay a higher interest rate if you want to borrow dollars compared to borrowing Bitcoins. That means people will actually committed more of their money, more of the money is actually already in the market. So this is a good trading indicator, but also this is actually how someone who is more risk averse might want to make money. For example, if you're just long-term bullish on Bitcoin, you're a hodler, you just want to buy your Bitcoin and hold it for 10 years, unless you're worried that Bitfinex is going to exit scam everyone, which is up to you, but personally I don't think so. you can put your Bitcoin on Bitfinex, put it in your funding wallet. You don't do any trading, and you just collect this interest, which right now for Bitcoin is a little bit less than 0.01% per day, which if you multiply it by 365, you get 35% interest per annum, which is pretty nice, I think, if you compare it to something like, S&P 500 or bank interest at 1.5%. I mean, that's pretty decent. And actually, even if you're not into crypto and you think Bitcoin is a bubble and a total mania and it's going to crash, how you can profit from this is you take your dollars and deposit them into Bitfinex and then collect the sweet 0.25% funding, which at this current interest rate, you're going to make almost 60% per annum, which is pretty crazy. I mean, even for crypto, it's not that bad. It's not amazing, 60%, I mean, per year, but 60% per year from an interest-bearing account is pretty amazing, right? So this is actually like, I mean, it probably sounds a bit scammy to anyone who is not in crypto, but in reality, all it takes is you make a Bitfinex account, you put your money there, and you put it into your funding wallet. Yeah, it isn't Tether. That's
The 10,000 minimum limit now.
They moved it to 1,000.
Did they?
Yeah, it's 1,000 now. I think they did, or maybe they're thinking about it. But yeah, there is actually a minimum amount you have to deposit in Bitfinex. But anyway, this is something you can decide for yourself if you want to do it or not. But basically, the interest rate for 2017, the entire year, the average was something like 40% for the entire year, including like the down periods and up periods. So if you think that Tether is not a scam, which personally I think it's not a scam, but many people disagree, you have to do your own research as always. Find what Tether is, how is it backed or not backed, if you trust Bitfinex, the exchange or not. If you are okay with it, put your money there instead of a bank account, get your 40 to 60%. That's really simple. And if you have any questions or concerns about that, you can actually talk to me in the Crypto Korea chat group later. I will explain it. So yeah, that's pretty much the way you can profit from crypto without really being exposed to crypto. And actually the lending rates right now are not even that high. They usually go higher if there is like a bull run or something. You can see some really crazy numbers. But that's another thing you have to consider if you're actually trading on margin. If you're like borrowing this money, interest rates are something you have to pay attention to because that can eat into your profits quite heavily. So anyway, enough about interest rates. So the long and short positions as your indicators. Keep in mind when you're thinking about opening a trade. Usually it's quite popular, in the past it was quite popular, maybe not so much now, for people to buy some kind of like coins, and be it Bitcoin or altcoins or whatever. When price goes up, people think, there is a breakthrough, the price is gonna go higher. Well, nowadays, with more people trading on margin, that's usually the opposite. If the price goes up, 5-10% in a day, usually it will just go back down unless something crazy is happening. So to be aware, to not get caught at the top of a move, this is definitely something you should be using. This is a very important indicator because let's say today, if this price, 9.5 thousand it is now, yeah, if you were at 9.5 thousand without this margin positions going up like this in the last few hours, I would say we're crazy bullish, there's still so much money available, just buy Bitcoin and enjoy the ride. But right now we already have people buy a bunch in the last few hours. It's not gonna move much more, usually. Of course, it's not a 100% indicator as always, there's many things involved, but that's one big thing to look at. So anyway, moving on from this, for anyone interested in actually trading and more specific things related to trading on margin, first of all, I have to make this disclaimer is that apparently margin trading in Korea is not exactly legal. If you're a Korean or you're a permanent resident in Korea, again, do your own research, make sure you're not breaking any laws, and don't blame me if police comes to you or something, because I am not Korean and I'm not really up to date on Korean law, so not something I can really comment on. So moving on from that, there are as I mentioned, two main exchanges for margin trading, Bitfinex and BitMEX, and they have their own pros and cons. Bitfinex is only offering up to 3x leverage, which means you can borrow 3 times the amount of money you have in your margin wallet. And the good thing about Bitfinex is that it offers a large amount of different altcoins that you can trade, unlike BitMEX, which is pretty much Bitcoin exclusive. It has some alts, but much smaller selection. For example, if you're on Bitfinex, you could be margin long on EOS, and instead of making 16% this day, you could be making 45% or whatever if you're crazy. But that's actually the reason why some coins which are listed on Bitfinex move kind of differently from other exchanges or even like coins that are not listed on Bitfinex. For example, if you look at Omisco, OMG, where is it? Let me find it somewhere down below. No, actually, so when Omisco was listed on, what was it, Upbit or was it Biton? Biton, yes. There was a pretty crazy pump for that, right, if anyone remembers. And if you look at Bitfinex prices, it went pretty high as well, like $20.50. But at the same time, on something like Binance and on Korean exchanges, it went to like $25 and even higher on Korean exchanges. And that's actually the result of margin trading. In traditional financial markets, really future trading and options trading and really margin trading is used as a way to actually reduce volatility, not increase it. Because usually, like, what a traditional trader might do is, if you're investing in some kind of like highly volatile stock that you want to hold, but you don't want to expose yourself to too much risk, you don't want to see like a 50% change overnight or something, you might buy, for example, 100,000 of that stock, but then also have a short position, which is called a short hedge, just so that basically whenever the price of that stock goes up, you lose part of your profits because of your short position going into negative, but then if the price goes down, you don't lose as much because of your short position giving profits. That's something people do a lot in traditional markets. In crypto markets, it happens sometimes as well, slightly differently, but you can see this effect of people basically using leverage trading to increase their profits, actually reducing the overall price moves. Because let's say you're a Bitfinex trader and you bought Omisco on margin with borrowed money at like $14, $15. If you see a price spike to 20, you are probably going to be thinking, I don't want to risk it. I don't want to see if the price goes even higher. I will just close my margin position. I will pay back that borrowed money and take my profits. On Binance, people are just saying, I have Omisco, it's a great coin, I will just buy more, it's, whatever. Even if you lose this pump, if the price goes down again on something like Binance or Biton or whatever without margin, you still have your coins. You still have, one Dodge is always one Dodge, one OMG is always one OMG. If you're trading without margin, you might not be so worried about taking profits. If you are, like on Bitfinex, obviously you will close your position much earlier just to make sure you are actually in profit and not break even or losing money. So this price, let me find the Binance to put it just side by side. Bitfinex and Binance. So